Hi there. My name is Scott Rawkins. I'm a mortgage broker with Dominion Lending Canada, and I wanted to take a few minutes of your time today to describe a few basic words that we use in the financial industry to describe your mortgage. And it has been my experience through the years of dealing with mortgages and clients that many of my clients, be they first-time homebuyers or experienced borrowers, don't fully understand or have some misconceptions about these basic words. So I'm going to share with you my knowledge on these things and just try and clarify a few details. The first thing that most people discuss when they're talking about a mortgage is their interest rate. This is the cost of borrowing the money from the bank. And there are two types of interest rates, generally speaking: a fixed interest rate, where you have a set cost for a number of years, and a variable interest rate, where you have a floating cost for a set number of years. The fixed interest rate is nice because it gives you comfort, and you know what your payment's going to be every month for a certain period of time. And the variable interest rates, they tend to be lower than fixed rates. However, they fluctuate whenever the prime rate in Canada changes. And the prime rate in Canada is set by the Bank of Canada, and also set by a number of financial institutions in Canada. And it is currently 3%. So a variable rate interest cost might look like prime minus 0.5%. So that might be 2.5%, and if prime rises to 3.5%, now you're paying 3%. And this can change your payment and the cost of borrowing the money over time. So you don't have as much certainty, but you generally pay less interest for taking that risk. So whether you have fixed or variable, you have this arrangement with a financial institution for a set number of years, which is called your term. And a term can be anywhere from 1 to 25 years. The most common term that people take is the 5-year interest rate term, closed fixed rate term. And what I mean by a closed term is a closed term means you're locked into that financial institution for that number of years. If you choose to leave that financial institution, you'll pay a penalty for doing so. Most mortgages are closed. You can also get an open mortgage. They're usually more costly, but they can be flexible for situations like when you're anticipating the sale of your home. So it's important to choose your term based on what your plans are, what you think life holds for you in the future, which of course none of us can really predict. But if you know, for example, in 3 years my job will be changing and I'll be moving to a different town, a 3-year term makes sense for you. If you know, for example, that in 5 years your son or daughter is going away to university, that might be a good time for your term to be open, so you can renegotiate your mortgage if you need to change properties, something like that. The next thing I wanted to talk about was your amortization, which is the total number of months or years that it will take for you to pay off your loan based on your current rate of interest payment amount. This is a bit of an estimate because your rate of interest and payment amount may change over time. You may choose to be more aggressive and pay things off faster, or you may need to reconsolidate some debts from outside your mortgage and add your credit card debt to your mortgage debt to kind of make things more efficient, and that can extend your amortization sometimes. So it's an important thing to understand, though, and all of these things work together to determine probably the most important thing on people's minds: what's my mortgage payment going to be, and is it going to fluctuate or not? So your mortgage payment is, of course, it's really a function of your interest rate and your term and your amortization. And there are a number of different types you can have. The most common would be monthly, which is simply that once a month you pay a mortgage payment. And that could be on any day of the month, but which day it is often has a lot to do with which day you bought the home. And you can have semi-monthly. So semi-monthly is a different arrangement. It's, say, 1st and 15th, and 15th and 30th. And the nice thing about semi-monthly is some people get paid semi-monthly, so that makes it very convenient for them. Their paycheck's going in their bank account and their mortgage payment's coming out. Semi-monthly, although it does have a minor effect on your amortization or how fast you will pay back the debt, not so much of an effect as bi-weekly payments. Bi-weekly payments happen every other week. And in some months of the year, 2 of them, there will be 5 weeks, so there may be 3 Fridays or 3 Mondays. So if you have bi-weekly payments, you'll end up with 3 payments in that month. There are 2 types of bi-weekly payments. One that's aggressively paying down your mortgage, and one that's making your payments smaller and more manageable. So An accelerated biweekly payment is aggressive, pays down your mortgage faster. This is how. If you had a monthly payment of $1,000 and you changed to accelerated biweekly, you would take half of that monthly payment, so $500, and you would pay it every other week. So there's 52 weeks in the year, so you would pay it 26 times. So you can do the math there. You'd end up paying, instead of paying 12 $1,000 monthly payments, you'd end up paying $13,000 in payments over 26 bi-weekly payments. So you get ahead by one payment. And so that's a fantastic way to pay down your mortgage. However, it's tough on your budget if you're paid monthly or if you're paid semi-monthly, because there's a couple times a year where you got to pay 3 payments and you get paid the same amount. So it really makes sense for people who get paid bi-weekly, and I really highly recommend it. You can also have regular bi-weekly payments that are non-accelerated, and they'll take those 12 monthly payments of $1,000 and they'll divide them by 26, so you just get smaller payments. If you get paid bi-weekly, I would always recommend use the accelerated option, depending on your budget. You can also have weekly payments, which are accelerated even more to more of an extent, and you can have those accelerated or non-accelerated in the same fashion. So you can make 52 weekly payments that are 1/4 of the monthly amount, and therefore speed up your mortgage, how fast you pay it down. Or you can take your 12 monthly payments and divide it by the 52 weeks and get a smaller payment. It's important to understand which one you have, especially if you're looking at payments and comparing between institutions. Understanding that you're comparing apples to apples is very important. I would always recommend pick a mortgage payment frequency that matches your budget. Make it easy on yourself. If you get paid bi-weekly, great. Take bi-weekly payments, and take accelerated. You'll hardly notice the difference. If you get paid 1st and 15th, take the semi-monthly. And if you want to pay down your mortgage, save some money up, and you've got it if you need it for something else, and apply it to the mortgage once a year. So those are the basic words I really wanted to discuss with you. And thank you for taking the time to watch my video. I hope you got something out of it. Please feel free to contact me either on my cell phone, 778-847-5905, or my home office, 604-971-4659. Or, of course, you can always email me at srawkins@gmail.com, or Facebook me as well. And be happy to help you with your mortgage, and look forward to speaking with you in the future.